All right, everybody, back at you with another video. In this week's video, I'm going to be going over a company that fascinates me, to be honest, just because of the kind of the picture it paints for the Canadian economy overall, the health of the Canadian consumer overall. And this is a company that I have followed for, I would say, the better part of 10 years. I used to own it way back in the day. It was a Stocktrades premium stock call in 2018. We followed it up until last year when it hit the $200 mark, and I ended up removing it from our list just because of my overall concerns with the activity of the company, the activity of the Canadian consumer, and just the state of the Canadian economy. And the interesting thing is this company is doing very, very well. And that is kind of what concerned me overall, and which is why I ended up removing it. I'm going to go over its earnings because its earnings were actually pretty solid. The company continues to put up record numbers. I'm going to speak on just the overall activity of Goeasy and how, it kind of paints that picture of the Canadian economy. I will go over what might be holding the stock price back because it hasn't really done all that well over the last year, considering, how much the markets have returned. And I'll just do a deep dive on the company and my overall thoughts. This is a company that I cover on the channel quite a bit, and people tend to enjoy the videos on it because it is a very popular dividend growth stock here in Canada. As always, everybody, if you want the stock that I am going to be buying, there is a free report in the description below. It's typically reserved for premium members, but I am giving it to everybody for being loyal readers, loyal subscribers. I was going to buy this stock this week, but with the transition to Questrade, when they offered me that big cash bonus to swap to them, I actually can't make any transactions right now, so I do have to wait a bit, but I am going to be pulling the trigger. But let's get right into the video. So for the most part, Goeasy actually ended up performing quite well on the quarter relative to analyst estimates. If we head to Y charts here and go to quarterly targets, we can see that the company reported earnings around 2% higher than expected, and revenue around 1.1%. So it generally was an inline quarter for the company. If we head down here, we can see that the company is pretty well known for either matching or beating expectations. We can see that it actually has not missed on quarterly estimates since Q1 2023, and it might actually go farther back than that. This is just the data that I have through Y charts. And when we actually look to the underlying quarter, record volume for applications for credit, up 28% year over year. We're looking at record fourth quarter loan originations, 814 million. That's up 15%. We're looking at 46,800 new customers. That's up 16%. And we're just looking at a company that just continues to grow and grow and grow. So why has the stock price not reflected this? Well, I mean, if we look to 1 year returns, the company's only up around 3%, whereas the TSX is up 23% and the S&P 500 is up much more than that. I do believe it is the worrying trend of these subprime lenders, how fast they're growing, the quality of buyers that are heading to the platform, and just overall the state of the Canadian economy. Because the one thing about these subprime lenders, they are going to be much more sensitive to the overall movements in the economy, to the overall unemployment rate than, say, a big bank, let's say Royal Bank of Canada. First off, they have much lower institutional investments. They primarily rely on retail loans to Canadian consumers, low to medium income. Not a lot of people utilize subprime lending unless they absolutely have to. They've likely been rejected from a big bank because of more stringent underwriting. They maybe have weak credit ratings. They maybe have too many loans originally, so they do have to head to subprime, where the approval rates are generally higher because the APRs, the interest rates, are much higher. So the company can still generate profitability with much higher charge-off rates and loan loss provisions. I mean, when we look to and I'll zoom in on this a bit, when we look to the net charge-off rate, it came in at 9.1%. So this is below the company's forecasted range of 8.75 and 9.75. However, it is trending up, and I will get to this in a bit. And when we look to loan loss provision rates, they increased to 7.61% compared to 7.38% in Q3 of 2024. So they pretty much state most of this is just due to unfavorable changes in the macroeconomic forecasts, which again, the Canadian economy is not really doing all that well. When we come down to operating income and earnings, we're looking at a 20% increase in operating income, adjusted 19.8. When we look to adjusted earnings, they're up by 11%. So the company is doing very well. We can see that its total yield on consumer loans, it is declining. However, it's likely to continue to decline just because of the regulations the government has put in on the maximum APRs. Goeasy was typically a company that was sheltered from this for the most part, just because they didn't have a lot of loans above that 30% threshold. So they're not all that impacted, but they've stated it in their guidance. These are going to continue to tick downwards, which ultimately does impact profitability. But I mean, if we look at the 26.1% in consumer loans receivable, we look to the 15.4% in originations, they're likely going to be more than able to offset this with increased revenue. So when we look to new customer acquisitions, record quarter for application volume, up 28% year over year. We're looking at just under 47,000 customers. Again, I mentioned that's 16% year over year. The one crazy thing here, net lending volume to new customers represented 71% of total credit advanced. I believe this company last year hovered in the mid 60% range. So a lot of new loans are coming from new customers. And one of the main things here, it's the growth in the home equity lending. So this is definitely Goeasy's highest credit quality product. I mean, it's backed by the home, and we're seeing quarterly home equity loan originations up 31% year over year. This is right off the top of my head. I'm not exactly sure if this is correct, but I seem to remember going over the company in a previous quarter, and this was at 50% year over year growth. Now, if we look to the loan to value, they're at 64%. So this is high quality buyers with a lot of home equity tapping into it with a subprime loan. Why would they go to Goeasy to get a subprime loan when they could probably get one from a major bank with likely a more attractive interest rate? Why would they go to Goeasy? And it's likely because of that cost of living crisis. It's likely because a lot of people are struggling financially right now. High quality borrowers, or who would have been seen as high quality borrowers, are now being very strapped for cash. So they're heading to subprime lenders. They're tapping into that home equity. Now, obviously, this is a kind of an estimation by me, but all the numbers kind of point to this being accurate. If we look to the auto financing, they got into this a few years ago. We're looking at record fourth quarter originations, up 31% year over year. They're increasing their dealer network. They're doing very well in the automobile sector as well. And when we come down to the Q4 highlights, we're looking at 45% of consumer loans now secured, up from 41.9%. So this is likely a result of that driving HELOC growth, those home equity loans, because those are secured loans because they're backed by the house. So we look to the 624 average credit rating. This is the highest in company history for the third consecutive quarter. Again, this is a good thing for the company. This is likely a weak thing for the Canadian economy. Canadians should not be having to tap into subprime credit, especially those with higher credit ratings, if they don't need to. So ultimately, Goeasy is benefiting from a lot of Canadians being cash strapped. So when we look to the overall charge-off rates, we can see that both delinquency rates and net charge-offs have been ticking up. I mean, we're looking at 5.8% in Q4 of 23 to 7.5% in Q4 2024. And when we looked at net charge-offs, we're looking at, 8.8, 8.8, 9.1, 9.3, and now it's kind of coming back down again. So this is well within the company's guidance, and I really don't think we need to fear anything here until that rate starts to tick up materially. If it gets to the high end of their guidance, I would expect we'll see some pretty big volatility. And overall, when we look to the quarter here, I mean, it was a very, very good quarter for Goeasy. Revenue, almost 20% increase. Looking again at, double-digit earnings growth. I believe they bumped the dividend by like 25%. The one area that is struggling would be their easy home segment. I won't really go over this too much because it's just such a small portion of the business, but overall, very good year from Goeasy, very good quarter, very good company. However, why is the company taking a bit of why hasn't its stock price done all that well over the last year? Despite growing revenue by 20%, despite growing earnings, I believe earnings on the year up like 15+%, the company's gone nowhere. I do believe it is a state of the Canadian economy at this point in time. Valuations are likely being a bit depressed here because of a lot of fears of how quickly the subprime lending market could fall out if there was higher unemployment in Canada, if we did enter a deep recession, and just overall the market is not willing to kind of pay the price for Goeasy relative to its earnings growth. And the one thing that is definitely going to kind of have a bit of a shock value here is the tariffs. So you can see here, Goeasy spiked. This was around January 24th, 2025. And when did Donald Trump say that he was going to put tariffs in place? It was around that time. And there was a lot of banks that had expected that if these tariffs are put into place, we will see double-digit unemployment in Canada. We will see all types of hardships in terms of recession. We might even see higher inflation. And the difficulty here is with a company like Goeasy, a subprime lender, if you're a Canadian consumer and you have all these types of loans, so you have a mortgage loan, an auto loan, and then you have a subprime loan with Goeasy, what is the loan you're going to prioritize? It's probably your mortgage first. It's probably your automobile loan. This loan probably goes on the back burner because ultimately it's probably a loan that you've issued in, you didn't really want to take out a loan from a subprime lender. That's kind of the state. That's who Goeasy benefits from, is people who are kind of strapped for credit. So ultimately, it's going to be very, very sensitive to Canadian unemployment. It's going to be very sensitive to Canadian economic growth. And I really do believe that's why the stock price hasn't really done all that much in the last year. Now, how are they expected to do moving forward? They reported their guidance. So Goeasy issues 3-year guidance. They expect consumer loans receivable. So in 2025, we're looking at a high end of $5.7 billion. And by 2027, we're looking at $7.75 billion. So this is big growth. They definitely do not expect things to slow down. And I had mentioned that total yield on consumer loans, we're looking at 32.5% at the top end of guidance in 2025. When we get to 2027, they're expecting that to dip down to the high end, 31%. Obviously due to those regulations and obviously due to probably a bit of the growth in their HELOC segment. So HELOCs are going to be higher yielding investments at Goeasy relative to, say, a major bank, because they're a subprime lender, they charge more. However, if their HELOC segment continues to grow, it's ultimately going to be higher interest than, say, an unsecured loan that could have crazy high APRs. Some of them are more than credit card interest. So ultimately, this is probably what will drag this down a bit. Now, when we look to operating margins, they expect those to improve. When we look to returns on equity, we expect those to be maintained. So this company is forecasting pretty strong growth over the while. There's no question about that. They've grown. The one thing they cannot forecast, and again, I'm not trying to kind of paint a bad picture on this company. I was bullish on Goeasy for many, many years. The only thing I'm speaking on right now is the potential risks of a bit of an economic fallout here in Canada, rising unemployment, some geopolitical tensions in Canada and the United States, where the United States could, slap an overnight tariff on Canada's lumber industry, on the automobile industry, on the oil and gas industry, let's say the dairy industry, maybe if there's concessions to allow U.S. competitors to enter, the telecom sector. All of these things could have a big impact on the Canadian economy and unemployment. And as a result, there is a chance we could see a bit more hardship here in Canada moving forward, and subprime markets are going to be the ones that feel this the most. And I know there had been mentions from their pitch deck here, from their investor presentation, about how resilient the subprime market has been during economic downturns. I mean, we could look to the .com bubble, which impacted Canada, but it was more so United States related. I mean, they have the 2009 financial crisis, auto collapse in Detroit, which ultimately would have impacted the Canadian segment just because of how much we rely on auto. We have the oil collapse in Alberta. So it kind of factors in the fact that, subprime markets performed better than prime markets during this time, which I will give it that. The data is, they're not fudging the data here or anything. However, I do want to go to a stock price chart to show you, just to give you a idea of the volatility here. I mean, we're looking at during the .com bubble, we're looking at back in 1997, Goeasy was $35 a share. We fast forward to November of 2000, it was $2 a share. Even, if we go to the financial crisis, March 24th, 2000, we could see they're around $10. They fell all the way to $2. So that's a 80% drawdown. If we fast forward to the financial crisis, we can see that the company here is around $19 a share. If we head down here, we're looking at $8 a share. So we're talking 60-70% drawdowns. If we go to that oil collapse in 2014, we're looking at $25 a share. The company bottomed out here around $16 a share, maybe going a bit below 16. So we're looking at a pretty big drawdown there. We go to the COVID bubble, we're looking at $74 a share all the way down to 29. We're going here to the 2021 when inflation started hitting, interest rates started rising. We're looking at $217 a share. The company dropped all the way down to $90 a share. Even when we come here to 2024, we're looking at $200 a share, and the company fell to $162 a share. Just because the subprime market has performed well, just because it's done well over the last bit here, is no guarantee that the stock price will not have gut-wrenching volatility. That's just kind of the nature of Goeasy. It's survived many financial crises. It will more than likely survive them in the future, but that does not save the company from a savage drawdown in price. It's going to be a very volatile company, and I have there's a lot of commentary out there on how, if we go to valuations, they say, the company's growing 20% and you're getting all this growth for at right now 10.7x earnings. That is true, but the market is also factoring in the quality of the company's loan book and the future potential economic issues in Canada. There is a reason why this company does not trade at a similar valuation to a big bank, despite the fact that it is growing at more than double the pace of the big banks. It's just a riskier investment. I mean, if we look to the 10-year median average, 11.95x earnings, this company has traded in this valuation range for around 15 years. I looked up the PE ratio. It's been steady for around, a decade and a half. So it's fairly safe to say that the company is likely going to trade in this valuation range for good. I mean, this is the multiple that the market is willing to give this subprime lender, so I really wouldn't think that you're getting a deal 20% growth for 12x earnings. You're getting right around what the market has historically paid for the company. Now, is it cheaper now? Yes, it's trading at 10.7x. When I removed it in the $200 range, it was actually hovering above this 10-year median average, and I felt that it just wasn't really, considering the overall circumstances, it really just wasn't worth paying a premium valuation for. Do I start to like the company right now at 10.7? It's possible. I probably want some commentary and maybe a final decision on tariffs to kind of see how this company is going to be impacted moving forward. But I just think you have to take the discounted valuations, the 12x earnings, with a grain of salt, considering the company's growth. The market is highly unlikely to ever reward this company with a higher multiple than that. So I think when you're valuing this company, using historical averages in terms of price to earnings is typically the way to go. There's a lot of risk in terms of this company's loan book that's being priced into this stock. That is why you see numerous banks like, let's say, Royal Bank trading at, probably 14x earnings, 15x earnings right now with a historical average of 12.3, but they're growing at half the pace of Goeasy. They just have a much more solidified loan book, less risk overall, prime borrowers, things like that. So do I think the company's a buy right now? I would say no, not yet. I would just want some clarification as to the Canadian economy, the health of it, the tariff situation, all the things like that. And then I will probably, no doubt, put it back on our coverage list over at Premium. I just don't think right now is the time to pull the trigger. Could I be wrong? Absolutely. Could the economic situation in Canada improve? Could tariffs be a non-factor? Could unemployment go down? Could GDP start growing again at a reasonable pace? Absolutely. And if that is the case, $175 a share is probably a solid price, but I'm willing to sit this one out on the sidelines for now. And if I'm wrong, I'm wrong. And if I'm right, I will likely get a much better opportunity to add in the future. So everybody, hope you liked the video. Head down below, subscribe to the channel, like the video, drop a comment. Do you own Goeasy? Are you looking to buy? And also head down to the description, grab that free report on the stock I'm going to be buying when my money finally shifts to Questrade. And also, if you want to grab that Questrade 3% cashback bonus, I will leave a link in the description as well. And stay tuned for more great Canadian content.